Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hello, everyone. Welcome to episode 80 of Carson's Facts versus Feelings. Ryan and Sonu back live. We've done a couple of recordings. Sonu is like riding a bike. We'll see if we remember how to do this or not. This is going to be a fun one. We're calling this one Total Eclipse of the Bears.
Boom.
There you go. So let's get into that. I mean, we've got about a hard 30 minutes. You and I talk and we go forever. So let's see if we can do something in 30 minutes. But
all right.
What'd you do yesterday for the eclipse? In Chicago, what percent was it totality wise? And what'd you do for the eclipse?
90% totality. Okay. So we didn't get full, I don't know, do you call it coverage? Whatever.
Sure. It's our podcast. We call what we want to call it.
We call it whatever we would, right?
Yeah.
But it was not quite a total eclipse over here. But 90%. I didn't use glasses. I did this old school cereal box pinhole technique, and it was I thought, let me try and take some photographs. It was okay, It was fun, whatever. My kids had a good time in school. I think they were kind of like, yeah, we saw an orange sun through our glasses. I was like, okay, maybe.
Boy. Could you imagine being a kindergarten teacher and trying to get everybody to wear those glasses and just do anything all at once? I don't know. That'd be hard. But so Cincinnati, we were 99% totality.
Okay.
That's what you call it. So it was. I mean, we weren't quite in the path, so to speak. We're right next to it. We were right there.
Right.
If we were going an hour north, I'm from Springfield, Ohio. That would have been in the path. But 99 was pretty darn close, and
very cool.
It was just neat. It was neat. It gets dark, it gets quiet, it gets cold, and it was a beautiful day yesterday. Today's cold and rainy. Man, isn't that nice that,
Yes, we lucked out.
The gods smiled upon us. So it was really cool, and it was neat because in 2017, I lived in Charlotte at the time, so I was in the path of that one.
Right.
And I did see Sonu. So we got to get into this. I know. You and I were born in 1978.
Okay.
When you and I are 99 years old in 2078, there's
Is
another
that the
one
next
of these.
one?
No. There's multiple.
Okay.
There's multiple.
All right.
But there's one in New Orleans. So how about this? When you and I are 99, we will go. Can you imagine New Orleans? We will go to New Orleans. I don't know if we'll still be doing this podcast. Whatever we're doing, we'll be doing something. I think how cool would that be to go to New Orleans
there you go.
when we're 99.
I just need some anti-aging pills or whatever, GLP drugs or maybe you should just ask our founder, Ron Carson. I mean, he seems to be doing well. He's found the elixir. He seems younger than me.
I mean, hey, you can probably New Orleans has a lot. You can probably find it in New Orleans. But anyway, the next one's I guess in 20 years, I think. But it's only in Montana, and then that's it.
That's
for
right.
North America.
Okay.
So you got to go to Montana. Anyway, so
that wouldn't
really
be a
cool.
bad trip either.
No, it would not be.
I've never been.
No, I said I want to go to all 50 states and have someone else pay for it. It's my joke, and I've never been to Montana either. So maybe we need to book that in 20 years.
There you go.
All right, well let's dive into episode 80. Total Eclipse of the Bears. Sonu, we're going to talk a little about the stock market and kind of market sentiment, where we stand right now. The economy, a ton of stuff's come out lately. We're going to focus again on the jobs number, maybe a little GDP as well, maybe some of those ISMs, the isms as they call them. And then the idea of no cut, really. Talk a little about the Fed. We've seen the Fed is floating. I guess you could say the idea of potentially no cuts. Focus on that. But let's dive in again on the stock market. Last week was quote unquote the worst week for the S&P 500 in months. It was down 90 basis points. Not for the week, 90 basis points.
Say that again.
Barely, down less than 1%. Yet the headline, the media, friends in the media, I work in the media, big fan. I'm on TV later today. I'm a big fan of the media. But the media have a job too, and they said worst week, in a long time. What's your take here? I mean, April's usually strong. The first week of April wasn't so great. I don't know. I mean, we've been bullish. What do you think right here and now?
I was just looking at a chart or a table you made the other day, and this was this was on a morning call that we were talking to our partners about, and it was just 8 times, I believe, 8 times if I remember right. You can correct me.
Who knows? Who knows? We had
2 back-to-back quarters of double-digit gains. So we had Q4 of last year, Q1 of this year, both double-digit 10% plus gains. Right? We haven't seen that. Just seen that 8 times in history. Yeah. Right. So, and momentum is real. I mean, over the next month, quarter, there's some consolidation. After that, you would think that would be the case. I mean, markets just don't go straight up. You want some consolidation, and that's healthy, if that's the word for it. But
Mhm.
over the full year, the next 12 months, momentum begets momentum, as I like to say. And, all else equal, you want momentum. You don't want, no, prices to go the other way. You want prices to be going higher.
Exactly. If you've listened to this podcast for a while, we've talked for a while about some of the momentum. And believe me, we're going to get into the fundamentals and the Fed and earnings and different things here later this podcast. But here are some just different ways to look at it. S&P's up 5 months in a row. 1 year later, higher 26 out of 28 times, up about 12.5%. Not too bad. When you are up in January, February, and March, the first 3 months of the year, like we just were, rest of the year, so that's the next 3 quarters, higher 19 out of 20 times, up about 10% on average. And when you're up the 5 months before, remember we were up in November and December, right, Jan? So those 5 months, the rest of the year, you ready for this? Higher 11 out of 11 times.
Boom. There you go.
And I had one more. Okay, so we just had the 100th day off of the not the bear market lows, the correction lows, October 27th. 100 trading days off of that just happened a week or two ago. When you're up, that was up 27%, by the way, in 100 trading days. That's pretty rare air. Sonu, I found only 10 other times in history back to 1950. You're up at least 25% in 100 days. 1 year later, S&P up 9 out of 10 times, up about 13% on average. 3 month and 6 month really strong as well. Yes, the one time it didn't work
was it 1987? Okay, I was trying to guess.
Usually time doesn't work. 87. Don't forget, stocks did gain in 87. They had a wild ride. We get it. So again, this isn't perfect, but I've got more of those, but we don't need to get into too many more. When the first quarter is up 10%, yes, you tend to see stronger gains going forward. It just continues to look like a bull market to us. Are there some cracks out there? Maybe. Some of the advanced decline lines are kind of, breaking down a tad here. We're starting to see some leadership from utilities. That's one thing that's caught my attention. Now, leadership's maybe a strong way to put it, but some recent outperformance out of utilities, not the end of the world. It's got my attention a little bit. But bigger picture structurally, hey, after a 27% rally in 100 days, maybe just a little bit of a consolidation is perfectly fine. And, we're still optimistic. Let's talk about sentiment. What do you see in sentiment here, Sonu, as we kind of move forward in episode 80 of Facts versus Feelings?
Yeah, actually, going back to that, you talk about the media and the headline. Oh, Dow has worst week, right? And if you think about, obviously you want clicks and things like that. I get it. Yeah. And we do the same thing too. I mean, we try to title our blogs and things like that, or even title our podcast episodes like that.
Exactly.
So we are all trying to do the same thing in a sense. But there are other ways to write that headline, right? Oh, Dow consolidates after 2 quarters of 20% plus gains, or S&P rising 20%, 25% over the last 6 months or so. There are different ways to say it. It just goes to show that I think people are still skeptical of the rally. I was just listening to the Odd Lots podcast, the episode Joe Weisenthal and Tracy Alloway did with Savita Subramaniam over at Bank of America. Great episode. I was amazed by this one thing she said. They take all the bulge bracket firms, all the sell side firms, and look at what their recommendations for asset allocation are. And if you aggregate all of it, right now, analysts or strategists are telling people, allocate 55% to equities.
Okay.
And the benchmark is sort of like your traditional 60-40 portfolio. So everyone's telling folks to be underweight equities in a sense. I mean, we run an unconstrained model where we can go from 0 to 100 for equities. You and I know that. We've talked about it in the past. We've made a 90% equities for the last, 15, 16, 17 months. Right. But goes to that whole thing about sentiment. I don't think you're not seeing euphoria.
No.
Right.
No. I've just always called her Savita. She's like, like Madonna.
Savita.
I did not know how to pronounce her last name, obviously. That's a very impressive job, but huge fan of Savita, but I just call her Savita.
Yes.
Good job there. Our friends at Bespoke did a study, one more. I just love these numbers. I think it tells a good story. On a total return basis, as of the end of March, on a 12-month total return, S&P's up over 30%. Okay, so that's like the past. You remember the banking crisis we had last March? Yeah, well, stocks gained 30% on a total return basis 12 months after that one. And according to the buddies at Bespoke, let me make sure I read it correctly here. Let's see here. 27 times we've seen an instance like that. 1 year later, S&P, these numbers might sound familiar to what I just talked about, but some pretty good returns. Higher 25 out of 27 times a year later. That's 92% of the time. Average return almost 17% a year after. You're up at least 30%. They took like the first signal, because sometimes these signals cluster. So they took the first signal in a cluster. But again, it's similar to the studies that I've just listed there, but Bespoke did a nice one there. But I will point out this. Let's talk about sentiment for a minute, but then we want to focus a lot on kind of the economy and the Fed. The AAII, that's what is no, it's the II. The II, what does II stand for?
Individual investors, is that it? Or institutional investors? I don't know.
I'm not sure. It's the
sorry. You probably know better than me.
I go by the acronyms. The II, bull bear spread, is the widest since February of 2018. The New York Fed has some polls that they do. 39% of the people that the New York Fed polled, the consumer expectations, what they call this one, 39% expected higher stock prices in a year. Now, 39% is not all that high. It is the highest since June of 21. And lastly, the Conference Board has another one of these surveys. The number of people expecting higher stocks in the Conference Board was 40. This is a year later, by the way, was 49%. That's the highest since late 2017. There's other ways to look at sentiment. I mean, but again, there's some pockets of a little exuberance. At the same time, I think maybe a little pullback would be perfectly normal. Maybe you could knock some of this off. What do you think of sentiment here, Sonu? Then we're going to move forward.
I think so. I mean, even if you take sentiment for the economy, what's interesting is people saying, oh, our own finances are good. In fact, if you ask people, how much do you think you'll spend over the next year? They say, okay, our spending growth will increase at a rate of 5%. Yeah. That's huge. Before the pandemic, it was at 3%. Right. And by the way, that's not all because of inflation, because inflation expectations are running at 3% or below, which is where it was pre-pandemic. So if you think about like 5% spending growth expectations, that's essentially nominal GDP growth. Right. I mean, consumers are telling us, we feel good about our own finances, so we think we're going to increase spending at that rate of 5%, which we haven't seen over the last 20, 30 years. Right. But at the same time, if you ask them, oh, how's the economy doing? Be like, it sucks.
Yeah, I mean, the small business survey, the NFIB, came out just a little bit before we did this. Maybe we don't need to get all into it, but they were like the most bearish they've been since late 2012. Small businesses. Let's think back to late 2012. Things were kind of wishy-washy. By the way, 2013 was a huge ripper of a rally. So, like, just because these sentiment polls are saying one thing, look what they're doing with their money, look what they're doing with their spending. CapEx is still strong. There's two sides to every coin. Anything you want to add to anything there before we move forward and talk about the economy?
Yeah, I think it's a nice shift to go from the soft. That's all the soft data.
Soft data.
Soft data has been soft. You and I have talked about the story ever since we started the podcast. I think we probably talked about it in our very first episode back in September of 2022. And here we are still talking about soft data. It is getting better. I should say consumer sentiment is getting better. No question. Sure. From the depths of 2022, it is significantly better. Small business sentiment is, on the lower side, but it is what it is, right?
Yeah, maybe some politics might be playing a part of that too.
Right.
Potentially. So, all right. So to speak of
hard data.
Yeah, hard data. Let's talk about hard data for a minute. Going to just veer off a little bit. We just had spring break, right? Let's talk about that for a minute. So the Detrick
you
family
were
went
out.
Yeah, we tried to help the economy. In fact, I'm sure we did. We went out to California last week, went out to Napa, Calistoga. It was an amazing time out there. Then came down to San Francisco for a day as well, hopped around. And the kids like San Francisco a little more. There's more stuff to do, as they put it. Kind of like wine country, a little more laid back and good food. But
did you guys go to the chocolate factory? Isn't there that big chocolate thing there? Is it the Ghirardelli? Is it? Yeah, I think it's a Ghirardelli.
Well, I saw like right there in San Francisco, like I said, the world's largest chocolate place right up there in Fisherman's Wharf. We didn't go into it, but we did eat a lot and had a lot of fun. All in all, it was a good trip. It's like I'm ready to get back to work and just
a lot of wine,
a little bit. Yeah, no, I don't drink wine. Honestly, I don't like wine. Yes, we did some. We did 2 different wine tours. Sterling Vineyards, which was awesome, and then another one I can't pronounce the name to be very honest. But we had a lot of fun. It was good. I'm glad to be back. Glad to be kind of catching my breath, so to speak. Yes. Done spending a lot of money on every meal, but it was a lot of fun. And you went to India. How'd that go?
I saw my nephew, who is 4 months old, so that was really exciting. My sister's baby, and we talked about it
Yep.
on the podcast last year when she was visiting the U.S., and that's when we found out the sex of the baby. So.
I was glad you didn't get arrested. I was like,
Yes.
oh, don't tell me you go to India and someone listens in India and they arrest you for doing that. So I'm glad you're back.
I'm back. No, it was just, like it was a great trip. I got to see my parents and family and friends, and so it was fun. It was just a week, but coming back is bittersweet because I'm leaving family there, but then I miss my kids and wife over here. So it was kind of nice to be back in Chicago.
Yeah.
Getting over jet lag, you get back in the routine. And,
Tell me about it.
It-
I'm only
it's-
dealing with 3-hour jet lag, and like today was the first day the kids had to go back to school, and it was just I don't know, nightmare is a strong way to put it, but it was a struggle. It was a struggle this morning getting them. One final thing about San Francisco, maybe the favorite thing the kids saw: the self-driving cars. I mean, they are real. Like,
did you get into one?
No, we didn't get into one, but I mean, they're legit. They look like RoboCop. Like if RoboCop were a car, that's what these things. They got like guns and stuff on this. No, they don't have guns. They look like they got cameras and. They're just driving around. Wow. They're all over the place in San Francisco. So really? I know it's probably normal for people to live out there, but to us, Midwesterners, it's like, whoa, there's a self-driving car. And you look at it like there's nobody in the driver's seat. And
I'm not getting in there.
I tell you, I don't know how. I don't know if it's Uber. Like you just do an Uber and it just picks you up. Like and you say, no, I don't want.
See, you and I are going to be in New York City next week. I wonder if they have it there. Maybe we should.
I've been in New York twice the last couple of months. I haven't seen any. Not to say they're not there, but I've never seen. I mean, in San Francisco, man, they are just there.
I can't imagine how it would work in New York. Even Chicago is probably a nicer city for driving, I think, which is not to say it's very nice.
Well, San Francisco is aggressive. I mean, it was nuts. Yeah. Like, I mean, I did not want to drive in that city. But anyway, all right, so we've got about 16 minutes to go. Okay. Let's talk a little bit about that economy. I guess we'll start with jobs and kind of filter from there. Sonu, once again, the monthly payrolls number came in, I believe, with 303,000, like 50% higher than expected. I think the 65 different economists over at Bloomberg survey, like 50,000 higher than even the most optimistic out of 65 economists. So literally nobody was looking for 300,000 jobs growth. So everybody saw that headline, fine. What I'm hearing, though, if you see people picking at it as well, it's all part-time jobs. It's all government jobs. You want to talk about kind of, maybe some of that's true, but how you also look at it?
Yeah, like let's just put this in perspective too. I mean, expectations are for 212,000 jobs. By the way, that's a lot.
Yeah.
Like in 2019, the average monthly job growth was 166,000, right? And payrolls blew past that. Now, two knocks. Quite a few knocks against, recent payroll reports. Jan-Feb payroll data was strong, right? No question. But then we got negative revisions to November, December, and then January again when we got February data. The unemployment rate was going up. It was at 3.9% in February. This report, I think, took those two talking points away, right? Because you got 303,000. Okay, maybe there's revisions, but Jan and Feb were revised higher. The last
time out. That's why we are calling this total eclipse of the bears. Yes. I mean, we're eclipsing all these bearish arguments.
Thank you.
Go ahead.
No, last 3 months, you take Q1, the average job growth per month was 276,000. Like I said, in 2019, it was 166,000. We are well above that. And then, yes, it's true. Most of the payroll gains are coming from healthcare and government. But these lagged the initial recovery in 2021 and 2022, right? And even government jobs, a lot of it is coming from state and local government and education. I mean, firefighters, policemen, teachers, they all count. They all spend money in the economy. I mean,
they count.
Like I said, they count, right? But then, okay, set that aside. You take the cyclical sectors. You take construction, leisure and hospitality, retail, trade. 109,000 jobs created in March. By itself, it's probably enough to keep up with population growth. You need about 100 to 125,000. Just these three cyclical sectors got us there. Construction payrolls, you take that. The most cyclical sector of the economy, probably the most geared to interest rates, up 91,000 jobs over the last 3 months. It's not even close to a recession. I mean, what more can I say?
Well, no, you can't say.
I can say more, but
yeah, you believe me. You and I both can say more. But I'm just kind of glancing at some of the notes I have here. Construction jobs. I want to talk about the household versus established survey.
Sure.
But maybe not quite yet. I thought I had something else I wanted to point. Oh, hours worked. There it is. So we saw a dip in hours worked earlier this year. You and I said, listen, What's Occam's razor, right? The simplest answer.
The simplest answer is the best one.
It was freezing. It was freezing, and it was a really cold. I mean, it's always cold in the winter, sure, but it was really cold in January. I mean,
it was colder than normal. Yes,
you and I did a couple of videos, and I had you outside. I was in California, nice and warm. It was really cold. We said, listen, maybe people aren't working as much because it's cold, and maybe they don't want to go to work, or maybe their work is just kind of shut down because it's cold. Talk to me about hours worked. That's come back nicely again, kind of an eclipse of a bearish narrative we were hearing 2 months ago, right?
Actually, the two positives, it's not even a spin. I mean, there's two positive sides to that story because, yes, hours work, in fact, came back in February itself, and it sort of normalized in March, right? Okay. The other side is, so aggregate income. If you think about aggregate income, total income growth over all workers in the economy, what is that? That's the sum of employment growth, hours worked, hourly earnings growth. Employment growth is strong. Hourly earnings growth is also strong. It's not red hot, so I don't think the Fed needs to be concerned about it, but it's strong. To aggregate income growth, last 3 months, it's up 6%, right? And that's well above inflation if you think inflation's running somewhere between.
Hold on. Oh, my goodness. Sonu, hold on. I didn't hit record.
Oh.
April Fools. I didn't get you on April Fools. I just made that. I got you. On the YouTube,
my heart just started.
I know your heart stopped.
Like,
he's
God.
Like, "Oh, Ryan, you idiot!" Because Chelsea, our producer, is not here, so it's very believable that I did not. I did. I did not get you for April Fools. I don't even know what you were talking about. It's this will be funny. We'll go for 20 minutes because he's got a hard stop anyway. The stuff we do.
You just killed me right there.
I know. I don't. What are we even talking about? I just ruined the whole thing. I was pretty
no.
Your face made it worth it though. So happy belated April Fools, my friend. Where were you? Remember where you were.
There okay. What are you talking?
I don't even know.
Know. Hours work. Hours work.
There we go.
All right. Let's go back there. Yeah. So anyway, I was talking about hours worked and then aggregate income. Hours go into that. How many hours people are working, and aggregate income is growing about 6%. Annualized over the last 3 months. That's nominal GDP growth potential, right? Because where does GDP growth come from? Mostly consumption. Where does consumption come from? Mostly incomes. But here's the thing. Hours worked has been flat over the last 3 months, more or less, which means we are producing a lot. GDP growth for the first quarter is expected to be around 2.5% or so.
Yeah.
We're producing quite a bit above trend growth by working the same number of hours. What does that mean? Productivity is higher. Right? Our entire Outlook 2024 theme, most of it was about productivity growth. It's nice to see that continue to play out in the first quarter. I mean, we wrote about it, end of last year, beginning of the year is when we released the Outlook. But yeah, like I said, it's nice to see that story continuing. Productivity growth, that's key for the economy.
Absolutely. We've talked a lot about why productivity is a big driver to this economic cycle. You can pay higher wages, puts a cap on inflation. The 70s did not have high productivity, had higher wages. It spiraled out of control in inflation. We've talked a lot about this, so we won't spend too much more time. But I do want to spend a minute because this is what I share on X/Twitter. These things I hear, well, you know what? All these jobs are part-time. All these jobs are part-time. And I did see a big spike also, I guess, in younger, like teenagers that are working. The most since, I think, June 2009. I mean, yes, there have been a spike in part-time jobs, but talk to me, Sonu, how worried should we be? Was it really all part-time jobs? What'd you find there?
First of all, I want to separate two things. I mean, you brought up the household survey. So the data comes from two surveys. The payroll data, employment data comes from two surveys. One is the establishment survey. It's a survey of about 150,000 businesses, things like that, establishment, right? And
that's the Friday. That's the big one. That's what we usually talk about. The Friday that we all talk about, right?
Right. Yep. But the household survey is actually where the unemployment rate comes from. The unemployment rate fell from 3.9 to 3.8%. That's good, but it's still higher than last year. Right. And so they're also measuring jobs by surveying households. And that's a much smaller survey. I mean, smaller is relative. It's about 50,000 households or so. But the plus minus there, the confidence intervals for jobs created in that household survey is about 600,000. There's a lot of noise, all that to say. There's less noise in the actual payroll survey, which you take from establishment. So when you talk part-time, full-time jobs, multiple job holders, all of that is coming from the noisier survey. All of that information is coming from the household survey. So keep that in mind anytime you see, part-time jobs are increasing. Okay, let's talk about part-time jobs. Turns out what's increasing is folks are working part-time because of what they call non-economic reasons, right? Maybe you want to take some time off, or maybe you want to take care of the kids or something like that. And the job market is hard enough that your employer is saying, okay, that's fine. That's what's increasing. In fact, that's not a bad thing. It's actually a sign of a stronger labor market. Part-time for economic reasons, which is when the only job you can get is a part-time job, which is that
Yeah.
tends to go up during recessions, things like that. That's actually, where as a percent of the labor force, that's slightly lower than where we were in 2018, 2019 at this point. So again, there's a different story there once you look under the hood.
Yeah, and I did notice also, like, number of part-time jobs just plummeted. I mean, absolutely plummeted during COVID. Like, a lot of people
Yeah.
lost their jobs. I mean, there really weren't that many. There were some. I'm making
Yep.
big assumptions here, but there was a huge drop. You could argue, and this is what I would argue, we're kind of normalizing. Part-time jobs are coming back because so many people lost them. There actually are a lot more part-time jobs now. So believe me, it's an interesting discussion. Bottom line, we still think the labor force is strong. You mentioned GDP. We've got maybe 10 minutes or so. So now I do want to talk about GDP. GDP came in. Oh, where was it?
GDP 3.4%. It was revised higher.
Yeah, so it was revised higher once again, but I guess that's fine. GDP strong, consumption strong. We've talked about it, but and this gets a little wonky, but it's one of those other things. We're talking about eclipsing the bears. Bears have been telling me for a year now. Well, GDI. I think you and I have even talked about this before on this podcast. GDI has been way lower than GDP. They should be about the same as you run a marathon, but GDI has been much lower. Now I want you to talk about GDI in a second, but here's what the headline was. GDI came in at 4.8% versus 3.4. It's the first time GDI was higher than GDP since the third quarter of 22. But if you average GDI and GDP, which I know you're going to tell us why you maybe should do that, it was a very strong 4.1%. So what is GDI? And is it finally just playing catch up to GDP?
Kind of. Two things. So there are several ways to measure economic growth, and you can quibble with all of them, right?
Yep.
One is GDP, gross domestic product. It essentially measures how much a household, businesses, government, all of them spend, right? And then net exports kind of adds or takes away if you have net imports, like the US has. Then there's GDI, which is actually the opposite of consumption because it's the income side, right?
Yep.
Instead of measuring what people are spending, you measure how much people earn because one person's income is another person's spending. So they should match in theory, but they don't because the sources are all different, right? And historically, you take an average of them and they kind of track, right? Now, over the last year and a half, we've seen a big divergence. And one reason is the two things. The most cyclical parts of gross domestic income, and our friends at Employ America actually said this, friends don't let friends quote gross domestic income without accounting for things, what's happening under the hood with corporate profits, right? The big two pieces of GDI that you want to focus on, one is the biggest source of GDI is what? Labor income. That's really strong. In fact, that's stronger than what we saw pre-pandemic. Just from that, you think we are a much stronger economy. And then the other side is corporate profits. Corporate profits have been very strong. They're up about 8% year over year as of the fourth quarter of 2024. But turns out there's a drag there because the Fed is included as a financial institution, right? Because it's a bunch of banks and they have losses on their portfolios of bonds. Why do they have losses? Because they raise rates themselves.
Yeah.
So it's like it doesn't make any sense and you have to take it out. Or I would say you should take it out. You don't have to, but you should take it out to get a better read on what's actually happening with incomes in the economy or economic growth. Once you take Fed profits or Fed losses out of corporate profits are actually up about 10% year over year. And this is different from S&P 500 profits because this is corporate profits across all parts of the economy, public companies, private companies, all of it, right? So profits are strong. Labor income is strong. There are some other quirks that were dragging GDI lower. But again, normally I would say take an average. That's the best thing. Right now, I would say you want to weight GDP more than GDI for any number of reasons. There's interest income. There's weird things going on there. I won't even get into it. So let's just keep it.
Well, I mean, interesting because I think for the year last year, S&P 500 profits are up like 2%, maybe, right? Just barely positive. But corporate profits are up significantly more. So anyway, some interesting ways to look at it. And I just know that GDI is one of those things that we've been hearing about from the bears, along with part-time jobs and different things. But we're trying to, eclipse some of these bearish narratives today. So the final thing, I don't know if it's bearish narrative, it's just in the news. So in the next 5 minutes or so, we've been hearing maybe the Fed is sending out some feelers potentially to see how the market reacts to maybe no cuts at all. Neil Kashkari came out last week on Thursday, I think it was, and he said maybe we don't need to have any cuts. There was another one. It was Waller. Waller was in the news maybe a week or so ago. Also, I forget the exact lingo he said. I know I've got it. I've got all these notes, but he hinted at maybe we don't need to. I can't. There it is. I knew I'd find it. Quote unquote. prudent to hold, according to what Waller had to say. It's probably more than that, but the market's saying, well, a couple guys are out there saying maybe no cuts at all. What are your feelings on what the Fed might be up to here with some feelers out there? Maybe there's no cuts coming.
I would go with what our friend Neil Dutta said. Follow Powell instead of Waller, and definitely Powell over Kashkari. Right?
Yeah.
I'm laughing, but for several reasons. Kashkari is a little out there with his views, which is fine. You always want somebody on the outlying, outer fringes, let's say.
Well, look at us. We were bullish a year ago. Everybody hated it. So sometimes it pays to be on the outer fringes.
Yeah. Look, but Powell said, the fear is, look, the economy is strong. The labor market is strong. So maybe we don't need cuts. Maybe you shouldn't get cuts. Maybe they won't cut. Right. But Powell said in his last press conference, this was just 3 weeks ago, he said, look, our target is not wage growth or the economy. It's inflation. Now, inflation's firmer in Jan and Feb. But he said, look, when it was really low in the fourth quarter, we didn't rejoice. So we took that with a grain of salt, and we are taking Jan, Feb firming inflation numbers with a grain of salt as well, right? So that's why they look over a longer period of time. And I think we are yet to get CPI numbers for March, and that will be tomorrow. We are recording this on the Tuesday. But I think even if March is slightly harder, I think it'll be definitely softer than February and January. So I think we're back into that disinflation trend. There's several reasons you and I have talked about why Jan was hot, why Feb was also slightly hot, things like that.
Seasonal quirks. I mean, they're honestly just seasonal quirks at the start of a year.
Exactly.
We've seen it before. It's sometimes that simple.
But the overall story, you're not seeing, for one thing, look at ask consumers about what are your expectations for inflation over the next year. That's consistently been below 3% over the last 3 months. Right?
Yeah, so that's why I was going to jump in. I'll just jump in. I mean, I've got you and I share the same brain sometimes. I was going to point this out also. University of Michigan, 3 months in a row now, sub 3% inflation. And the New York Fed has inflation expectations of right about 3%. That's the third month in a row, right about 3%. It's not like it's dropping a lot, but it's kind of hanging out there. And
before the pandemic, it was not even. It wasn't like it was 2% before. It was about 2.6, 2.7%. So we're not far above it.
No, we're not. And also before this little kind of sticking around 3% for the New York Fed. Just remember, inflation expectations have been down 8 of the past 10 months going into that with a peak of, you're going to love this, June of 22. June of 22 is when everything peaked. Expected 6.78%. Now we're down to 3. And again, it's been lower. It's been expectations on inflation. New York Fed, 15 of the past 20 months. So listen, what did Powell say again last week? And he said this many times. He wants to see inflation expectations lower before he considers cutting. He remembers the 70s. I don't know if it was a self-fulfilling prophecy or not, but people did not expect lower inflation back then, and they didn't get it. Powell has said many times when the microphone's in front of him, he wants expectations from consumers to remain low on inflation, and that's happening. I cut you off, Sonu, but go ahead and wrap it up in a minute or two.
Let's riff off of that inflation expectations, right? Because as you said, inflation expectations peaked in June of 2022, and they've come down. So consumers, I mean, most people are not the best forecasters of future inflation, right?
No, they're not.
But what the good signal from that?
Neither's the Fed sometimes.
Yeah, neither's the Fed.
I didn't say that out loud, but yeah.
But the signal you can take from that is consumers are good at telling you what today's inflation is, and they're just projecting that into the future. So if you take that, we think inflation expectations are going to be 3%. Essentially, what they're telling you is current inflation is 3% or below that. Right? Before the pandemic, even in 2019, they were telling you current inflation is about 2.7, 2.8%. Right? By the way, that's consistent with the Fed's target of 2% inflation. Consumers always see, prices higher than, it may be on average or average as measured by CPI, PCE, whatever. Right? So I think that's the signal I take from inflation expectations. Like, that's what consumers are experiencing right now. And that's sort of normalized. I think that's a good signal. You look around the world, right? Europe is seeing lower inflation.
And lower rates. They're lower rates across, not so much in the U.S., but other parts of the world are seeing lower rates.
So there are, the Swiss National Bank just cut, interest rates for the first time. So all that is happening. It's not like, inflation's going to spike here by itself, right? 2 years ago, we had a lot of inflation. The whole world is seeing inflation. This is a very different situation. Despite, I know oil prices are going up, gas prices are going up as well. But then natural gas prices, which matters for utility prices, that's going down. So that's the other side of the coin, right? Food prices are going down as well, or there's disinflation there. I shouldn't say prices are going down, but it's not as much inflation as we saw a year and a half, 2 years ago.
Well, They were expensive in San Francisco, feed prices, when I was out there. Yeah, shout out to Sam's Social Club in Calistoga. If you ever been out to Calistoga in wine country, it was amazing. Yes, it cost a little bit more than maybe what this Midwesterners used to, but boy, oh boy, that was good stuff at Sam's Social Club. All right, Sonu, I know you've got a meeting to go to. Again, this was the first live podcast we've done in a few weeks. Next week's podcast, Sonu and I, again, we were in New York for a couple of days, so it'll be with Dan Ives. We've recorded it from Leap Day. The Dan Ives will be episode 81. It was an amazing discussion about how Dan sees the world, sees the future, sees technology. You're going to love it. But hopefully you enjoyed episode 80 of the latest Carson's Facts versus Feelings. Again, titled it Total Eclipse of the Bears. I think it's
you can just play that tune in your head.
Play that. A total eclipse of the sun. Play. Or total. What is it? Total eclipse of the heart.
Total
eclipse of the heart. Sorry, yes. I don't know what I'm talking about. Yeah. Sorry. I looked at the eclipse yesterday, so this is proof. No, I didn't look at it. All right, everybody, have a great week. Again, we'll be back in 2 weeks with a live one. But you're gonna love the next one with Dan next week. So take care. See everybody later. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.